Is now a good time to refinance my mortgage? So this is a question that came from one of the viewers. If you have any other questions, put them in the comments below and I can answer them as well. So number one, what are your closing costs or fees that you're going to pay? Typically, you're going to pay about 2 to 6%. And those fees are going to go to origination fees, appraisal, credit check, title, tax, insurance, escrow, filing fees, basically inspection, attorney fees, and some others. Question two, how long do you think you're going to stay in the house or at least own the home? If you're thinking that you're going to sell this in the next couple of years, it's probably not worth it. But if you're planning to stay for at least 3 years, it starts to make sense. We're going to check the break-even time in months, and I'll put a calculator in the description below, so if you want, you can put your individual situation, because we all have slightly different situations, and see what that looks like. Three, we're going to ask, is the current interest rate lower than the loan that you had? And keep in mind, do you have a fixed rate mortgage or do you have an adjustable rate mortgage? So that's going to come into play. Fixed rate's a lot easier because you know what it's going to be for the next, 10, 20, 30 years. Whereas an adjustable rate mortgage, that rate may change in a year or 5 years from now or something along those lines. And then those rates might be 1% higher than the current rates. If my interest rate on my mortgage is higher than what the current interest rate is, and it's more than about 0.75%, then it can start to make sense. But if the interest rate continues to drop, it might make sense to wait, but we'd never know what the future holds, so you don't want to wait indefinitely, let's say. And we need to assume that you're still having an income, so if the interest rates are dropping, you're going into a recession generally or an economic slowdown, and if that's happening, potentially there's job losses, so it gets harder to refinance or get loans if you don't have stable income. One area within your control, you can work on your credit score. This can lower your interest rate by about 0.5% depending on where you're starting and where you get to. You might find that if you do a credit check, you have things that are actually not your debts or anything that are disputed. You can dispute those and they can go away and immediately increase your credit score, which then lowers your interest rates if you go for a refi. You can also pay down debts and other things as well. Another thing that you can do is if the interest rate on your mortgage is lower than the current interest rate, which is for a lot of people at the moment, I'm in the same boat. What you can do is you can still lower your monthly payments with a principal overpayment. And you can use the existing low interest rate, and there's something called a recasting. The thing I like about recasting is I can keep my same interest rate and say my remaining loan term would have been 25 years or something, but I've overpaid by several thousands of dollars over the past couple of years, or I had a bonus or some other windfall or inheritance or something along those lines. What you could do is you could take that money, put it towards the mortgage, pay down the principal, and then reduce your monthly mortgage payment. And for me, a recasting of my mortgage would be about $300. It's going to vary by mortgage company. Most of them allow it, not all of them. And you might only be able to recast the mortgage once. So keep that in mind. And with the recasting, instead of paying all these fees for the loan origination and those types of closing costs, that money would go directly towards the principal, and just it's less money that you owe long term. Number four, who to contact. I would say I would first start with my current lender. I've sometimes seen there's no fees and it's free to go with a lower interest rate. And that's because they don't want to just lose people, because they know if interest rates drop significantly, people will start to refinance with another company. So they'd rather keep the business, and sometimes they can do that for free. The benefit with this is if you think interest rates will continue to drop, currently interest rates are dropping. I feel like they're going to continue for some period of time. And you don't know when the bottom is. If you refinance, say after 1% drop or something like that, but there's no fees, and then you wait another 6 to 12 months and it's dropped significantly more, you could potentially then refinance at that point as well. If you can't do that with your current lender, you can go with a broker. And the reason why I like a broker is you're not tied to one institution. There are many different options, and the broker can find whatever the best deal is for you. So if that's, having the lowest closing costs, or the lowest interest rate, whatever that may be, they can help you figure that out. So next we go through our break-even analysis. So I'm going to look at a loan balance of $300,000 for the remaining mortgage. My assumption is it's a 30-year original fixed rate mortgage. I got 25 years left, 25 years on the new loan. I'm not pulling out any money. I don't want to buy any points because if I refinance, those points are effectively wasted money. Looking at the fee structure, fees usually range between 2 to 6% when you refinance. So I put the percentages in the dollar figures here. So the fees would be $6,000, $12,000, or $18,000 to refinance. We're going to assume we started with a 7% interest rate. We drop 1%, we go down to 6%. So what's our monthly savings? Here we have $176 of savings across the board. So then we look at our break even in months. You get 34 months here, so that's just shy of 3 years. Remember what I said up here. If you're going to stay at least 3 years, maybe it starts to make sense. But if you're going to move in a couple of years or less, then it's probably not worth it. So here you need to stay 34 months to break even. Otherwise, it wasn't worth the refinance. Here you got 68 months. Here's 102 months. If the interest rate dropped further and went down to, say, 5%, the monthly savings would be $345 across the board. You go through your break-even analysis in months. Here you have 17 months, just shy of a year and a half, 34 months, just shy of 3 years, 52 months, just shy of 4.5 years. So you get the idea that if you refinance, it's not like you have a ton of money all of a sudden. It actually generally will cost some amount of money to refinance. So some people will take a cash out refi or they'll cover the cost in the refinance, but then that gets tacked on to the balance. So you might not see as much in terms of monthly savings. So I hope you found that interesting. If you did, I cover a lot of financial topics on how to make more money, how to save, how to invest, how to be an entrepreneur. So if any of those interest you, please subscribe and have a great day.